Hi, my name is Roger Schluter. This video today is really, the title of it is really, are you asking for an audit? And certain ways that you do your tax returns, sometimes you are asking for an audit. So anyway, there are many items in your federal tax return that can increase your chance of an audit. There are the way you file your tax return, and then there are items within your tax return. This video is going to list the items in the order of the highest chance for an audit to the lesser chances for an audit. So anyway, number one, the biggest chance of an audit or to have SBA scrutinize your tax return would be if your filing status is the head of household. And this is due to the qualification errors regarding dependents and support requirements. You have to be very careful with that. And you have to be a head of household to get the Earned Income Tax Credit. The Earned Income Tax Credit, or the EITC, as the IRS refers to it, when claimed by a taxpayer, it actually, when taxpayers claim this tax credit, half of them contain errors. 50% contain errors. The IRS knows this, and they focus in on a lot of those when they see the head of household, and then they see that if they took the Earned Income Tax Credit, they go ahead and focus in on that. This makes the head of household and the Earned Income Tax Credit as a frequent target by the IRS for an audit. Number two would be filing Schedule C, profit or loss from business or profession, sole proprietorship, especially if you have high losses, because a lot of people figure, well, I'm going to have these losses because I'm doing it myself. There's no accountant to tell me how to do it, unless you're having it done by an accountant. That happens sometimes. But a lot of people, they do these themselves and they get carried away, and it's very easy to get carried away with you've got your income at the top line, and then you've got all your expenses, and then your income minus your expenses gives you your net profit, and your net profit is what you get taxed on. So a lot of people, it's fairly easy to fudge these numbers, and the SBA or the IRS knows that. So anyway, the IRS will go ahead and scrutinize a lot of these a lot more. If your business has losses for 3 out of the last 5 years, the IRS will consider your business a hobby and not a bona fide small business. And you could get in trouble because you've claimed all this stuff and you've got all this tax. They could disavow a lot of these things. So anyway, you can get in trouble with that. So that's the second way. The third thing is actually unreported or mismatched income. And this is usually done when the taxpayer omits. Usually if you get additional income in many different forms, you get a Form 1099 from whoever gave you the money. And, usually it's from a side job, a brokerage account, a crypto platform. Really it can be from anything, but it's usually something you do to generate income. And they do a Form 1099. Now they send it to you, but they also send it to the IRS. So anyway, the payer will send the IRS the Form 1099 and also send you a copy. So when these do not match up, you will be asked about it either by a letter or an audit. Now it kind of depends. Audits, if they think they're going to find other stuff, they'll do an audit. If they think you made just one little mistake on it, they'll send you a letter or something that'll just say, hey, fix this and either pay the tax or whatever and then come back. Now notice, pay the tax. The IRS doesn't usually have you change things where you get money back. Usually they have you change things when you have to pay money. So you really need to recognize that and realize that. Anyway, that's the third thing. The fourth thing would be excessive deductions related to income. And this can happen, like on the Schedule C, happens when the taxpayer has too high an amount. And a lot of times this is like, if you have too high an amount of charitable deductions, your home office deduction is really high. I have a video where I talked about, I had one client who his whole house was a was the home office deduction. And I said, you can't do that. And he goes, sure I can. My whole house is my office. And I'm like, okay, but we didn't do that loan, by the way. So anyway, it's usually when the taxpayer has too high an amount of charitable deductions, home office deduction, vehicle expense that do not align with his current income. You know, if you have a small income, but you got these huge expenses for things like charitable deductions and that, and they just don't match up, the IRS will look into that. Number 5, holding foreign assets, usually in the form of foreign bank accounts. Now, they always ask you, do you have any foreign bank accounts? They ask you that on every tax return, no matter what you're sending in. And that's the reason, is because usually people try to hide income offshore and they think nobody will know about it. But anyway, it's usually holding foreign assets, usually in the form of foreign bank accounts. And then there's 2 forms that you will need to fill out depending on the amount of your foreign accounts that you have at other banks that are outside the U.S. There's a FBAR that is for 10,000 or over. And then if it's 50,000 or over, you have a form 8938 that you're supposed to fill out. So anyway, you know, that's another way. So those are basically the, you know, the 5 ways, the biggest things that IRS comes up with people. So just don't make these mistakes, or if you want to make them, just realize what can happen or what may happen. Usually most people just blame stupidity. Oh, I didn't know, I'm not an accountant, I'm just doing my own taxes and blah, blah, blah. So anyway, there are other ways to increase your chances of an audit, but these are a lot of the main ones, and these are the ones that a lot of people have. And a lot of not your big people, well, maybe foreign bank accounts might be your big billionaires or whatever, but a lot of times these things are your small guys, you're just your everyday workers that are filling out their tax return and whatever, maybe you have a Schedule C with it, or, you know, whatever, you know, claiming charitable deductions, whatever. So anyway, yeah, it can be the little guy. A lot of times the IRS, you know, it's a lot easier to catch the little guy than the big guy. So anyway, please subscribe and like the video. My name is Roger Schlater, and I will see you in the next video. Thank you very much.